Hi everyone. We've talked about discount rates in our previous two videos which covered the time value of money. And it's this discount rate that we're going to be looking more into in today's video. So there's a couple of different ways of referring to discount rates, and you may have heard me refer to it in this way in the previous two videos as well. So sometimes it can be referred to as the required rate of return. Sometimes it can be referred to as the discount rate, sometimes the opportunity cost, and sometimes the cost of capital, right? And all of this is referring to the exact same thing. It's referring to the discount rate, and that's this R that you can see over here in the formula. Like all of these are used to refer to that. So some people might call it the opportunity cost of capital, the cost of capital, the opportunity cost or the cost of capital, the discount rate, the required rate of return. And depending on the scenario, you might be tempted to use one phrase for it over the other. And in particular, we're going to focus on both of these, the opportunity cost of capital and the cost of capital um, explanations for this, because I think they give a good intuition as to how we can choose this discount rate R. Because in previous videos we just took it as a given. Someone would say, or I would tell you on the slides, oh, your opportunity is to invest at a 10% rate of return, and then we would just take that as a given. But there's probably a bit more um, sense in explaining how exactly you can arrive at that yourself. So one way to think about the discount rates, as I mentioned, is to think of it as the opportunity cost, right? And the opportunity cost is what you forego. It's what you give up as a result of making a choice. You can think of it as your next best alternative option, or what you would have done otherwise, right? So let's say that the two opportunities, let's simplify this very much so and say there's only two opportunities that's available to you. And the first one is to invest in company one, and the second one is to invest in company two. And I use the word invest over here very loosely because I don't actually mean it in the strictest sense of, buying the shares of company two. This is a lot more broader than that. This could be buying the shares in company two, which is the first one, or it could also be investments in terms of time. So, for example, invest in company two by performing some analysis on them, or choosing to be employed by them, or anything else, right? But something important over here is, let's take the example of time, right? If you choose to put in 1 hour into company one, let's say for the sake of employment, so let's say you're employed by company one and you're working for an hour for them, that is 1 hour that you could not have spent in company two, right? So by choosing one, you are choosing to forego or to give up the other. And that is your opportunity cost. By choosing to go with opportunity one, you are choosing to give up opportunity two, and that is your opportunity cost. And similarly, if you went for opportunity two, then you are giving up opportunity one, and therefore opportunity one is your opportunity cost. And so, as you can imagine, any choice that you make has an opportunity cost, because whatever it is that you spend doing that thing, whether it be money, whether it be time, whether it be anything else, that money, time, or anything else could have been spent elsewhere as well. Okay? So now let me give an example. So suppose you can invest £100 right now at time zero, right? And that's why I have a minus sign over here, because this is money going away from you. It's going out of you, and that's why there's a minus here. And as a result of that, you can invest this £100 and you can get 150 in 1 year's time, right? This is the offer that's open to you, right? Now, in previous examples, I would always tell you, well, your opportunity is to invest it at a 10% rate of return, and then you can just use that to calculate the present value of this 150, net it off against this 100 that you're losing, and see if it's worth taking or not. But now I'm going to explain that in a slightly different way. Suppose your alternative, right? If you were to not take this choice, this offer that's presented to you, your alternative is to invest that £100 in a bank at a 10% rate of return. So you can either choose to invest in this option over here, invest £100 now and get a £150 in 1 year's time, or your next best alternative is to invest in a bank at a 10% rate of return. Okay, so by choosing this, you are foregoing this, and similarly, by choosing this, you are foregoing this, right? And that's why this is related to opportunity cost. And the way of representing this alternative in a number line or a timeline similar to this is by saying, well, I will invest £100 now and I will get 110 in 1 year's time. And that is the 100 invested at a 10% return. That gives you 110 in 1 year's time, right? And if you were to do the calculation, well, this option over here gives me 150, this gives me 110. So this is better than this by £40. And that £40 is what you get in 1 year's time, right? We want to convert this into time zero money. So that's the worth of it right now. And you can do that by taking that £40 and calculating the present value of it at your next best alternative, which is this 10% rate of return. So that £40 divided by the 1.10 to the power of 1 gives you 36.36. So what we're saying is that this option over here is better than this option over here, our next best alternative, by 36.36. Okay. Now, let's say I give you the same opportunity but slightly changed. So now you invest £100 and you get 105 in 1 year's time. Again, your alternative is to invest that £100 into a bank at a 10% rate of return. And the number line for that, the timeline for that is given over here, just as it was before. You invest 100 now and you get 110 in the future. This time, our option over here is worse than this by £5 in 1 year's time. This is 105. This gives me 110 in 1 year's time. So this is worse by £5. If we calculate the present value of it at this next best alternative, right? We always calculate the present value at the next best alternative because this is the option that is always available to us. So you're always benchmarking this against what you benchmarking any opportunity. So this is an opportunity, for example, benchmarking that opportunity against your alternative to see if it's worth it or not. And in this case, the present value of that is negative 4.54. So that means that this option over here, this new option that I have presented to you, is worse than your alternative option over here by £4.54. Right. So you can see as soon as we introduce an opportunity cost, a next best alternative, whatever you would have done with the money otherwise, you can suddenly compare the options that are open to you, the opportunities that are open to you against this benchmark and see whether it's better or worse. In this particular case, it's worse because it's giving you a negative payoff, right? It's giving you a negative payoff over here. So it is worse. So your option over here is worse than your alternative. Whereas in the previous example, we got a 36.36, and that was a positive figure, which means that our option, our previous option where we invested 100 and got 150 in the future, was better than our alternative by £36, 36 pence in today's terms. Okay. So the opportunity cost can vary between investors because, like I said, the alternative or the benchmark that you use as your opportunity cost is something that is individual and something that is available to you. So in the previous example, or in the examples that we covered in the previous slides, that opportunity was to invest in a bank at 10%. But that could vary, right? If I went to a bank, I might not get a 10% return. I might only get a 7% return or a 6% return. Similarly, if someone else went to a bank, they might get a 12% return or a 15% return, right? So depending on the investor, their alternative option that's open to them, their next best alternative can vary. And if they vary, then of course all of our calculations will vary as well, right? So everything that we've done is for an individual investor. And so depending on the investor that you're thinking of, you will need to change around the opportunity cost, and therefore this will impact your calculations as well. Okay, so opportunity cost is individual specific. It is a way of comparing investments from an individual's point of view. The other thing that we looked at was cost of capital. And cost of capital can be thought of as how much return do my investors require for every £1 they choose to invest in my company. So investors can purchase shares of your company and they can invest money into your company in the form of capital. And how much return are they demanding for every £1 that they choose to put in your company? That is your cost of capital, right? And this works exactly identical to opportunity cost, right? But we're just going to be doing the calculations a slightly different way this time around, and that's just to explain the same concept but in a different way. But if it makes more sense, you can do it exactly as we did before, and you will get to the same result. So again, let's say that the company has a project where they can invest £100 and get 150 in the future, in 1 year's time, right? And the investor says that for every £1 that they choose to invest, they need to get 20% returns on them. Okay. So now we lose the £100 and we gain the £150 in 1 year's time. But again, you can't add both of them together because they're in different units, right? This is money received in 1 year's time. This is money right now. Or using our previous analogy, this is in grams, let's say, and this is in kilograms. And you need to convert them into the same unit to be able to add them together, right? So when you convert it into the same unit, you are doing 150 divided by 1 plus 0.20. And how do we get this 0.20? Well, that is this benchmark, this 20% cost of capital that we were looking at, right? And what does this give me? Well, the answer of that is 25, right? So what this is telling me is that this option that's available to this company, this project that they can invest in, it is better than the required rate of return, the cost of capital, what the investor is demanding for every £1 that they invest. And it is better to the tune of £25 in today's terms. And that should make intuitive sense, right? Because this project over here involves us investing 100 and getting 150 in 1 year's time. That means that this project is returning 50%, whereas the investor is only demanding 20%. So this must be better than this over here. And that makes sense because the project is returning 50%, whereas the investor is only demanding 20%. Now, that was one way of looking at it, but you can approach it in the exact same way that we approached the opportunity cost of capital. Sorry, the opportunity cost as well, right? The way that we did that was by saying, well, if the cost of capital is 20%, if the investor is demanding a 20% return, then if we invest 100 now, they will be expecting to get 120 in 1 year's time, right? And this opportunity that the company has to invest £100 is better than this benchmark, this opportunity cost by £30. What is the current value of that £20 of that £30? Sorry, it will be 30 divided by 1 plus 0.20 to the power of 1. That 0.20 is simply this 20%, and that gives me the 25. The 25 was also what we calculated in the previous slide by doing it through a slightly different method, right? Both of them give you the same result, so whichever makes more intuitive sense to you, follow that method. both of them are identical. As we said, opportunity cost and cost of capital refer to the same thing. They're referring to the discount rate. So the actual process that you use is the same. Okay. Now here we have another project where we invest 800 and we get a 120 in 1 year's time. Again, the cost of capital, the investor requires a 20% return for every £1 that they invest. In this case, the project returns 20%. It gives me 120 for an investment of 100, and that means that my opportunity over here gives me a 20% return. Right? This opportunity over here gives me a 20% return. Now that is also the same as this cost of capital, the required rate of return demanded by the investor, right? So my opportunity over here gives me the exact same return as what my investor is expecting. And so when we actually do the present value calculation, where we take that 120 divided by the 1 plus 0.20 to the power of 1, and then we minus 100 from it, it gives us a 0. And that's because this gives me exactly what my investor is expecting. Nothing more, nothing less. And that's why this is 0. In the opportunity cost example, you'll remember that we got a negative 4.36 at one point. And that was because the opportunity was giving me less than the opportunity cost, what the investor required. In one of the examples, the result was a positive 36.36, and that's because this opportunity was giving me a higher return than what the investor was requiring. And in this case, this opportunity is giving me the exact same return as what the investor is expecting, and therefore the excess return is £0. It is giving me exactly what the investor expects, nothing more or nothing less. And again, the cost of capital can vary between companies, right? A riskier company might have a higher cost of capital because investors will say, well, you're a bit more risky than the other companies, and so I actually need a bit more return from you to make up for that risk, right? So cost of capital can vary between companies, just like opportunity costs can vary between investors, right? So our opportunity cost was a way of comparing investments from an individual's point of view, whereas cost of capital can be used or can be thought of as a way of comparing investments from a company's point of view. And that brings us to the end of the discount rate discussion. Thank you, everyone.